Hello and welcome. My name is Joe O'Mara. I'm the Head of Aviation Finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by Eamonn Bane. Eamonn is the CEO of Macquarie AirFinance. He's joining us for the purpose of our Aviation News Report for 2025. And we are recording this in late November. Eamonn, thanks for joining us. Before we get into the meat of the conversation, do you want to tell our watchers a little bit about Macquarie AirFinance?
Sure. Thanks, Joe. And thank you to KPMG and Airline Economics for putting on this series. Much appreciated. More recently, we brought in two additional shareholders, PGGM, a Dutch pension fund, and the Australian Retirement Trust, an Australian superannuation fund. They've helped grow the business to now 320, a fleet of 320 aircraft, and that includes an order book of 83 aircraft. Our teams we have a global team with offices in Dublin, San Francisco, Singapore and London. And we have a very committed team of experts dotted around those various offices.
Excellent. Well, Eamonn, taking that in, right, and we'll definitely touch on pieces of Macquarie AirFinance as we go through, particularly in the order book, and really want to chat about your investment grade as well as we get into the conversation. But maybe focusing first on the customer side. Very large fleet, wide number of airlines that you interact with. Can you talk to us around how you've seen the demand environment evolve over 24? And are there any kind of interesting trends you're seeing from a geographic perspective?
Sure. We have a very diverse portfolio of customers. We've about 90 customers spread across approximately 50 countries. So we've had a long history of serving the global markets. Our fleet today is heavily weighted in Asia. We see 40% of our fleet in Asia and 30 in Europe and smaller percentages elsewhere. We see that constant demand now driving a need for aircraft across those regions. Some of those regions have some softness in various pockets of the markets. I've spent some time in Asia more recently and in particular in Japan. And while Japan domestically is performing well, some of the outbound international tourism maybe is a little slower. To give maybe an example, we've seen the impact maybe of the yen, meaning that outbound tourism to Hawaii from Haneda has gone from load factors of in the 90s down to load factors in the 60s. Similarly, in China, we've seen domestic markets performing exceptionally strongly over the last number of years as the recovery has occurred, but internationally we've seen less traffic for various reasons. Consumer sentiment in China and maybe a softening in the economy in China, but also some constraints around European connectivity with the conflict in Russia and Ukraine. So we see, broadly speaking, a very positive story around demand, and our fleet of in-service aircraft remains strongly sought after, but also our order book, our placements have been very strong in the last 12 to 18 months, and we see that backdrop continuing, notwithstanding the constraints that we see around the supply chain and the predictability of the delivery schedule.
You might come to that supply chain in a minute, but if I keep you on the maybe airline performance side, sounds like a pretty robust demand environment that you're seeing. All right, some softness across. And as you assess that demand environment into 25, are you more or less bullish than you were 12 months ago? So we're kind of seeing, there's always macroeconomic and geopolitical challenges. Do you view those as heightened or about where they maybe were pre-COVID?
I think there's continued uncertainty in the market, but there's a backdrop of a very strong, resilient market in general. Pre-COVID, we often saw, and one of the things about our industry was there was from time to time pockets of uncertainty that drove softness in markets for periods of time. We've seen more stability and resilience in markets of late. But we shouldn't expect that necessarily to be plain sailing across the board. So we do expect to see some capacity normalization over time. But the backdrop of the lack of supply and the catch up, that lost production that we've had over the last 5 years, that catch up takes a very, very long time to service the demand, the ongoing demand, the global demand that we see. So I expect 2025 to be an even better year than 2024, and we see that in our lease extension activity and our releasing activity. In our releasing activity this year, we've released a number of aircraft, and those aircraft have been released at above 20% above appraised lease rates. So we see that as being very strong. We've a number of airlines that are coming to us and extending aircraft out beyond the historic kind of 24, 23, 24-year-old markers where maintenance cost impacts on willingness to extend. So we see an extension of the economic life cycle, but also airlines looking to avoid redeliveries and maybe seeking to purchase more aircraft than we have in the past.
And on that lease extension point, comparing this again maybe to probably pre-COVID times, how much earlier are airlines engaging around seeking to hang on to that lift?
Sure. I think we've seen that kind of cement now over the last 12 months or so, where airlines have been waiting for the market to develop and have had an expectation that there'd be more aircraft available. I think airlines are looking to secure capacity now a lot further out. So those conversations are happening earlier. We see conversations for extensions now, and maybe conversations around transitioning into new aircraft orders happening earlier. So a lot of our conversations now around aircraft that are redelivering in 2026.
Yeah, so again, a push forward of all that, which bring you back maybe to your supply side issues. As you mentioned, Macquarie AirFinance have a significant order book. If I'm not mistaken, you're both across Boeing and Airbus. Can you talk to us about the challenges that supply side dynamics are having on the business?
Sure. I think the very obvious impact is on constraint on growth and predictability of that supply for growth. And that's on our order book, where we work very closely with the manufacturers on the exact delivery schedule of our order book. And we mitigate any risks that there are for our airline customers in terms of that delivery horizon. But it is inevitably slower than we would like. And also the supply side has been constrained into the airlines directly, so the sale and leaseback channel is not as plentiful as it has been in the past. And with the large number of competitors seeking to also grow, it means that that is a difficult market to secure significant growth in. So our committed order book of 83 aircraft give us a pipeline of growth, and while there's some potential movement around when those aircraft deliver, we see that increasing predictability coming in as the ramp up continues. Very encouraged to see Boeing resolve the recent strike, and expect to see Boeing getting back to a path of ramp up pretty soon. Airbus have a path to rate 75. They've recently adjusted that from 2026 into 27. So we see this constraint on supply really lasting through the back end of the decade into the next, and that's where our order book currently is scheduled. So we feel very strongly around the lack of, or the constraints around supply having two-pronged impact for us. One being negative in that there's constraints about our growth, but there's a larger positive impact where if an airline wants a new aircraft from the OEM, they have to wait until well into the next decade now, or into the next decade now. So the leasing channel will be heavily in demand. So we can offer aircraft in that period, and our existing fleet of aircraft remains heavily in demand throughout that period. So we're probably seeing more extended demand on our existing fleet than we had predicted before. When we were in the depths of COVID, we always had a high degree of confidence in the recovery of the market and the pace of that recovery. We got maybe two things wrong. Was the timing of the recovery. It took a little longer to come. but also the impact on the supply chain we didn't predict. But having that fleet of aircraft in our portfolio, we sought to not lock in poor performing long-term deals, but have aircraft available in this recovery period and be able to place our order book in that recovering period as well. So we've seen a very strong backdrop to our placement activity in that front.
Yeah, it's interesting, isn't it? Like, a lot of people, you go back to 2021, were very pleased themselves in writing very long lease extensions in that low interest rate environment and a slightly different demand environment. And I think people would like a few takebacks. So just to ask you maybe a net question, as a 300 plus aircraft owned or committed, the way the supply environment is, net positive or net negative for Macquarie?
Net positive, certainly net positive. Having the fleet allows us to take full advantage of market conditions, and we've, like I say, a fleet where in COVID we very purposefully reduced our average lease term remaining, and that meant that we had to explain that we had more near-term activity. But that was really positive then as we came into the recovery, and as we continue in the recovery, most of those deals have now released and extended on much stronger terms, and we've gone longer. So we've gone from an average lease term remaining of 3-point-something years up to closer to 6 years remaining on average in the fleet now. And we had the confidence to do that because of the rate backdrop.
And maybe bringing you on to the trading environment then, I think, when I was having these conversations a year ago, you had basically a very stodgy trading environment where there wasn't really a lot happening. You had the larger guys hanging on because they're worried about supply side. It seems as if we've seen a material uptick in activity. Does that follow through on what you're seeing?
Yeah, absolutely. Maybe going back a year or two even before that, we saw very little trading activity because the buyers were chasing distress, and we were never going to be a distressed seller. So we always felt that there was that was going to be a period where we just sold less. As we've come out of COVID, we've seen values rebound strongly for a number of reasons. Clearly, there's a lot of liquidity coming into the space, but also the actual metal values have increased on the back end due to OEM pricing increases, inflationary impacts, and we've been able to benefit from that. Our trading tends to be focused at this point on older non-core assets, and we've seen a lot of demand in that space. We recently brought a portfolio of 12 aircraft to the market, average age of 18 years, and we had 20 bidders on that package. And from a wide range of bidders, we see a lot of engine solution demand, where the engine market is quite strong at the moment. So buyers looking to shore up engine supply. As well as buyers looking to take advantage of the strong leasing market there is for older aircraft, maybe that wasn't there in the past. So we see both the values recovered very strongly, but also the level of demand for aging assets has increased dramatically.
And bringing back to a point you mentioned on lease rate factors materially increasing, as you say, which feeds in on one element to that demand and supply imbalance. It's also reflective of a heightened interest rate environment. And again, a year ago, we would have been talking about interest rates being higher for longer. We're into the first starts of what will hopefully be a round of cuts. As you assess it from Macquarie's perspective, how much does the interest rate environment impact on your business plans, and how does it feed into what you expect to do?
Yeah, I guess that probably leads into our journey to investment grade as well a little bit. I think we see the interest rate market now as maybe not having the same certainty around the cuts than we had expected a little while ago. There's certainly uncertainty in the market there. We went on our own journey about 18 months ago where we sought to achieve investment grade, and in doing so we took some pain earlier on going to the unsecured capital markets and raising a number of bonds. Over time, as we achieved that investment grade rating, we achieved it quite quickly. We felt we had a very clear path to achieving that, and we worked very hard to do so. But in achieving the investment grade rating, we've brought our cost of issuance in from 8 3/8 down to 5.15 was our more recent more recent issuance. So that's a more than 300 basis point tightening for us. So we see spreads today as being very positive for us. The underlying interest rate we can't control much of, but we see us having hard assets that we can add the impact of maybe over time, add the impact of any interest rate movements into our leasing activity. So overall, we believe that having our investment grade rating will give us access to strong pools of capital, unsecured capital in the unsecured issuance market.
And can I talk to you about that journey to investment grade? And really curious around, as the rating agencies were assessing you, where were they placing the most weight? Was it kind of the nature of your metal, the diversification of your lessees, the unencumbered nature of the fleet? How did you find, I know it's a jigsaw that they're putting together, sure, but certain pieces are weighted heavier than others. What was that like?
Yeah, I think it was a wide range of elements really that make up our stability. We have a very strong shareholder base. Macquarie have been committed to the business for 18 years. We have a very solid platform and demonstrated through various cycles that we can perform and do perform very strongly. We had a diverse customer base and asset base, and we had an ability to grow. What we needed to do, and we knew we needed to do, was we needed to flip our capital stack from predominantly secured to unsecured. So,
can I ask you, did they give you a target on that percentage-wise, or they just told you need to get it down?
Yeah, we knew we had to get below 30% of secured debt to total assets. We sit a little bit below 20% at the moment. So we knew we had a journey to go on there. While rating agencies don't give firm targets, they give you guidance on where they'd like to see. But it's not just one element. So we really had a lot of work done over our at that stage 16-year history to build our story around a very solid and stable leasing platform with a very stable asset base and a committed growth that gave us a strong platform for growth. So we worked with the rating agencies for quite a while on sharing our story and going along on that journey and really being consistent with what we said we'd do. We did. I think we were fortunate to have a very decent market backdrop to be able to do that in, and we really were quite pleased as we look back on the time it took us to achieve that investment grade rating.
Yeah, as you say, hopefully a differentiator going forward where you're talking, 10 players or less that are able to tap that from an aircraft leasing perspective. I might come back to that investment grade and scale point in a second, but before I do, maybe if we keep with the broader debt markets, as you say, your own strategy clearly over the last couple of years is, okay, we'll take the pain and go high yield unsecured until we can get ourselves into, as you say, 300 basis points less. But as you assess the wider aviation debt market, how do you view it from a health perspective? And I appreciate that's a wide gamut, and I might park ABS for a moment, but if we think maybe on the traditional banks or the alternative lenders or structured product, your assessment on the health of that market?
I think there's sufficient liquidity there. I think different platforms will be able to access different elements of that, those debt products. The traditional banks are in the market. Maybe there's limitations on the volume that they can provide, and in some cases the pricing that they can do it at. But we have a very strong relationship with our banking partners, so we see ourselves as accessing the secured market for a piece of our debt. And being now an investment grade lessor, the unsecured capital markets will be our primary source. And we believe that the depth and the breadth of that market is quite constructive for continued growth. The alternate lenders, there's clearly a place for alternate lenders as different types of buyers seek to add on debt products. Alternate lenders tend to be and tend to do well in that market. And as you mentioned, the ABS market coming back on stream now in a big way over the last number of months is a very positive general direction.
And when you assess that ABS market, it's kind of interesting as we have these discussions. Sometimes wonder we spend too much time talking about ABS, right? Even at its height, it's kind of 10 billion of assets in any given year, and so much more is happening. But we do spend a lot of time talking about it. And is it a channel? You can tap the unsecured markets. You're not going to be out there raising ABS funding. But as a significant trader of aircraft, how important do you think that channel is to the kind of secondary market more generally?
Sure. I think as you alluded to, it's not the most efficient debt for an investment grade lessor. But at the same time, it's very encouraging to see that market recover as it just bringing additional liquidity into the market. I would like to see the E-note market recover, which I think will enhance the tradability of where we might be able to tap into is in trading portfolios. But certainly it's very encouraging to see the return of the ABS market, and it is important to certain buyers of aircraft that is available to them to support the acquisitions that they have planned.
Maybe if we move on to the investor side, Eamonn, to get your thoughts. Been phrasing this as I've been asked this question. We've come through, an outsized impact from COVID on aviation finance. We've had probably an outsized impact from the Russian invasion on aviation finance, but the answer back to some of those is just the overall resilience the sector has shown, the ability to keep airlines alive, maintain cash, still return profits. Do you think, as a sector, we are more, less, or the same levels of attractiveness to investors as we were in 2019?
I would say inevitably more. When you just listed out some fairly large events that had negative impact, and when you go back a step and talk about include the Boeing grounding, flowing into COVID, the Russian war, various other impacts of in-service fleets, whether that's the 787 or the A320neo, the GTF impact on various groundings. The industry has seen a lot of bumps in the road, or maybe larger bumps in the road, and we've seen that massive drop-off in traffic. One thing that we were always confident in was where people could travel, they would travel, and that's where we saw certainly the recovery post-COVID was as we expected. Every other cycle included a similar kind of return once there was a renewed confidence in economic confidence. It drove a sharp recovery in traffic. As we look to how investors view it, certainly we see lessors across the board having performed very strongly in that period, high period of distress for our industry. We've never seen a period like it, but a very large majority of lessors performed well and were able to service their various debts, and have come out of it with pretty solid balance sheets, having gone into it in a very strong position. Our own history, we have a bank heritage, and therefore our approach to risk is very strong. As we came out of COVID, we didn't have the impact of Russia, so we were able to focus very clearly on that taking full advantage of the recovery and seeking strong growth opportunities without being distracted by a recovering aircraft out of Russia.
And maybe keeping with the macro leasing environment, maybe bringing back to the point I mentioned at the start, you've got 10 or so investment grade lessors that have that ability to tap the deep pool of capital that is the unsecured bond market. What else you can't? Maybe the odd person has a strong shareholder behind them, but it if you posit a theory that ultimately scale is going to become more and more important in this business, do you see a world where that kind of top 10, or maybe brings a couple with them, start to break away from the wider market and everyone in behind is kind of trying to find a niche that works for them?
Sure, I think inevitably, and we've seen this playing out, the bigger lessors get bigger, and it means that the smaller lessors continue to be challenged in growth and how they achieve growth and where their volume of growth comes from. And that becomes a little bit cyclical. You get different types of equity as well. Maybe some are longer term holders and some are in for the more build and flip type of investment. So I see the larger lessors seeking to maintain that scale, and scale will continue to, people's view of scale will continue to grow, I think, and develop. But certainly it is very difficult now to add high quality growth at the type of return expectation that investors might have.
And that would posit then that you might see more consolidation in M&A. You guys have done a little bit of inorganic. Is that something that you think will become more important as those larger lessors seek to maintain and grow that scale, particularly given the things you said around the supply side constraints or the sale and lease back kind of concentration?
Yeah, I think it does. I think we've been fortunate to be, first of all, have the skills and the ability to do larger scale transactions, M&A type transactions over the years, the more recent one being the Alafco portfolio. And that means that we can tap a number of growth sources at any given time. The M&A large portfolio being one, the smaller secondary trades, sale and lease backs, as well as our order book. But certainly we see that there will be continued opportunity in the M&A channel or the larger portfolio channel as lessors and their shareholders seek to divest or find that growing is too difficult and they're forced into that position. And this has been an industry where we've always seen opportunity for consolidation, and I think that will continue now.
Changing gears, maybe aiming to get your perspectives down around the climate challenge and the impact it has, honing in really on a lessor. And I know it'll be interesting when you've got that bank relationship in behind. And if I think I had someone in a banking environment, particularly European banking environment, sitting in here, they'd be talking about the regulatory challenges they're facing, how that's knocking on for their business. Yet sometimes I chat to lessors and it's, that's going to come in and impact us at some point, but does it change my price of debt at the moment? Does it impact who I can attract for investment? Not really. What are your perspectives?
Yeah, I think it certainly influences very strongly what we do. We want to continue to support our customers in the transition to new technology, and that's certainly a focus of our investment. And certainly it's a strong mandate from our shareholders. We have shareholders that are very focused in the green transition. And they're very supportive of our growth in that direction. So as today we have 40% new technology. As we bring in our order book, that will continue to grow. In a couple of years, we'll be north of 60%. And we want to try and do more and see how we can support the industry in achieving those Paris-aligned targets. And certainly our shareholders are also invested in other areas of the green transition, investing in SAF, large investments in SAF production. So we see ourselves as being having strong support to encourage and provide support to the industry in transitioning to an asset base that provides support on the decarbonisation of the industry.
One as a large lessor that has very much been able to fund the newest, most efficient technology.
Yeah, and I think to maybe you mentioned the debt focus at the moment. You mentioned the European banks and maybe their interest. We see more sustainable linked financing opportunities out there, and that's certainly something that we're exploring with our banking partners about what is the right type of sustainable debt product.
Really interesting insights there, Eamonn. Before we close, and I always like to ask this question, as we sit here in late November, what are your optimism levels like as you look out into next year?
I'm very optimistic, Joe. I think the supply-demand imbalance will continue inevitably. One thing that we mentioned earlier on about the OEM production capability, it's quite predictable for quite a few years out. So we know how much new aircraft are going to come into the market. We know what the level of demand that will be there, or we have a good idea. Notwithstanding some of the headwinds or uncertainty that's out there in the markets today, we expect overwhelmingly positive demand for aircraft over the next number of years. So really, I feel the backdrop for us and our portfolio and our platform in general is very strong, and certainly with our stable shareholder base, who encourage us to find high quality, high value growth. I think we feel pretty good about what the next couple of years hold.
Well, on that optimistic and hopeful note, Eamonn, I'd like to thank you for your time and insights, and on behalf of KPMG and Airline Economics, wish you and Macquarie AirFinance a very successful 2025.
Thanks, John. Thanks very much.